And one stock which stands out is Mankind Pharma. That company reported a very good set of numbers. It is the second quarter since listing that they reported. It is a revenue growth of around 18%, margins 25%. And the key driver has definitely been the growth in the domestic pharmaceutical space, where the pharmaceutical market for them has grown around 14%. Chronic segment has done very well in the Indian market for them. So that's Mankind. There is a conference call underway, so we'll try and get more details. The stock is up around 7.5% at this point. But talking about the entire pharmaceutical healthcare space, Metropolis Healthcare reported what was a weak set of Q1 numbers. This weakness is in line with the Q1 update, which indicated subdued revenue and margins. In fact, the margins have come in at a multi-quarter low, mainly on the back of lower revenue growth and marginal cost increase. To discuss this, we have with us Ameera Shah, the promoter and MD at Metropolis, joining in. Ameera, hi, welcome to the show. If you could just start by talking to us about what competition was like this quarter. We know that a high base of COVID, summer holidays, all of that, and the loss of the government contract, all of these factors impacted your numbers this quarter. But what was competition like in routine and semi-specialized tests?
So just before I comment on that, Ekta, usually Q1 is our lowest quarter in the year. That's commonly known amongst analysts and investors. And usually we do see the lowest margin in Q1 because of lower revenues. Having said that, in Q1, we saw a 9% volume growth and an overall 12% revenue growth in our core business, which was probably the strongest in the industry. So I think we are very much on the right track. As far as competition, I think last couple of years, this is not new in our industry. We've seen many years new competition coming in. But I think the assumption that most people have is that when health tech competitors came in and started deep discounting to consumers, it would have a great impact on pathology incumbents. And actually, it depends on the kind of incumbent you are, and you've therefore faced either pressure or no pressure. Metropolis has always built our business through going to specialist doctors and getting recommendations of prescriptions. So it's been a very scientific reach out. And therefore, we have not seen our B2C or D2C impacted by deep discounting of new competition coming in. The other side of competition has been more brick and mortar, hospitals, some pharma companies, some pharmacy chains, and some other corporates have come in. And again, we find that mostly they are building their business on the B2B side in the semi-specialized segment by deep discounting. So again, there is in our healthcare space, there is a head and a tail. The head is the quality customers, the sticky business, the good quality stuff, and the tail is all the people who are more interested in pricing and discounting. So we've never built our business too much in the tail, always in the head, and a lot of the competitors are building more in the tail. So therefore we are not seeing too much of an impact on that. B2B also in quarter one, we've seen a 9% increase year on year. So it's been quite strong and positive.
Ameera, hi, good afternoon. This is Sonia here. I take your point that up until now, perhaps you haven't seen that kind of intense competition kick in, but at a time when your costs are going up and perhaps there could be some pressure from competition going ahead, do you foresee further weakness in your margins? Is that something that you're taking into consideration? And if yes, what do you think the margin band could be by the end of the year?
So Sonia, first of all, I think last year, FY23 was the most competitively intense year that we've seen in pathology in a long time. I think that is actually behind us and not ahead of us. We have actually seen competition starting to lower their discounts. We've seen less of a funding. We've seen more rationality come in. So actually, I think it's more behind us than ahead of us. We have to not assume that margins are impacted by competition. It is not. It is our own choices. So for example, while pre-COVID, we had a 26 to 27% margin. Right now, we are adding about 30 labs in the year, which is diluting our margin by about 1.2%. Now, this is a conscious choice because we believe that's the right direction for the business in the mid to longer term. The second thing is, as we know, like we said, the B2G contract, which exited in the last quarter of the last year, has obviously added some margin pressure in the first quarter. But first quarter is always the lowest margin. So over the course of the year, we are very comfortable that we should be at the similar margin profile as last year. Quarter 2 and quarter 4 will outperform. Quarter 1 and quarter 3 will always be lower in revenue and in profit growth.
All right. So you are likely to maintain your margins as of last year. What about the other parts of your business, the ones which are growing much faster, which is your premium wellness contribution, which you expect to take it all the way up to 20-25 odd percent. You had taken some price hikes in April. Have you taken some more in this quarter? And new network contribution, how much will that be a part of your overall sales?
So actually, if you see out of the 12% growth on the core business in Q1, 3% was from the new labs that had started and 9% was from the existing labs that were already there. As far as price, we took a very marginal price increase in the end of April, which contributed about 1%, to the benefit in the quarter. So out of the 9% volume and 3% RPP, revenue per patient, out of the 3%, 1% was contributed by price and 2% by product mix. We are not intending at this point in Q2 to take any price increases. Q1 also was only on some very selective specialized tests. Our focus at this point of time is really volume growth, and therefore we believe that we would like to continue to build volume at the current prices.
Okay. Ameera, just about the premium wellness segment, there's so much bullishness across diagnostic companies on that particular segment. Thyrocare has Janch, Dr. Lal's has Swasthfit. You all also have done very well in your premium wellness segment. Do you think that is going to be the next focus of competition amongst players?
It already has been, Ekta. I mean, if you see the last 2-3 years, especially during COVID, is when we saw a change. We saw a lot of these health tech companies come in and start pushing wellness as a concept of doing more and more sort of bundle of tests. Consumer mindset has a little bit transformed from there, where they're feeling that, look, if I'm giving my blood, I might as well do a full checkup at the same time. So we are finding that patients that are walking in are preferring to actually up their prescription to a bundled package which has more tests. And that is part of what is aiding the wellness package business increasing. So it's really more of a consumer demand that is moving it versus anything else.
Right,
and the competition has already been quite high in this segment. So I'm not sure whether, we can always see more, but it's already been.
Okay, good to hear that, you're not really hit by competition across the board. I mean, you're battling it well, whatever it is, and all the best for the quarters to come. Thanks a lot, Ameera, for joining us and clarifying on several issues and answering all of our questions. So that's Metropolis. The stock has been under pressure actually in the last 1 month. It's down about 7-8% despite a very strong market. So the street is clearly concerned about the margin pressure that the company is seeing. Let's slip into a quick